Okay, so in this video, I want to go over some of the questions you guys had for understanding. Before we begin, let me just... Okay, I'm ready. All right, so let's see. The first thing I want to cover here is the theory behind sampling. And this is a big theory, and you have to understand how it works. And I think I went over it, but I just want to go over it really quickly. Sampling is a process like the scientific method in terms of how you get a sample or you sample something, you get a data point. So when you think of like liquidity, I call it a bullish or a bearish sample. We'll say bullish sample here. And it's because we're getting a little data point, if we could fit that in the box here, this little data point that's letting us know about the bull's activity. So what it comes down to is when you don't have a sample, you are blind. And in all of scientific theory, it all comes down to data. It's not about the type of data or this or your thoughts. You get your data and you use the best known methods to assess that data. And your data can have certain qualities, or it can be good, or it can be bad, it can be biased, it can be a lot of things. But the point is, it's all about data and data interpretation. And the data in this case is not all of the prices. It's not all of the volume. It's just certain specific prices and certain specific volume, which have particular qualities to let us get I believe, a better look at the bulls or the bears. So in the sample, what creates this data point is you get liquidity. And liquidity in this regard, and there are a few definitions of liquidity, with this regard, liquidity is the production of open interest, the production, not the happenstance. It's not random. It is the known process, the production of open interest to bundle up and offer. I hear an echo in my house. I think somebody's listening. Somebody watching my YouTube? I think somebody's watching this video in the other room. Okay, sorry. It's the production of open interest to hand to, but not guaranteed. Just because you have something rich people want does not mean, well, they usually want, doesn't mean they're going to take it from you. So this is the data point is they create the liquidity. So it's created, and we're using open interest transference or open interest given. Create the liquidity. Then we offer it. So you create it, then you offer it. Then we take this data point and we get another data point. And this data point is the response. So just because there's liquidity doesn't mean that's guaranteed there's bulls or bears. The reason that we can say that liquidity that wasn't consumed by institutions can get liquidated is because of shadow bears or bulls. When I say shadow, I mean they follow around institutions. The thing that makes shadow bulls and bears different from bulls and bears is that these guys have the money, they're smart, they can read the data, they're missing one thing, and that is accurate narrative. This is the thing that they're missing. So in other words, they always buy liquidity and they always sell liquidity. They don't really care about what's going on. Basically, they're sitting down at the card table, and anytime they have a hand that looks promising, they always bet. They're sort of opportunists. And that's very different than somebody who only bets when they have a good hand and they're beating their opponent psychologically and maybe some other things line up. So they're not intelligent, they're smart. And that's different. In my opinion, being intelligent means you can figure out what's going on overall. So this is an important piece of this whole thing, is you have to understand the process of data collection. I don't accept all data points. I don't care. I will accept things that are not in this system that we're working on right here. But, I have a different set of rules about how I use that. For this system right here, we're just looking at liquidity and the impact and stuff to build the base backbone structure of markets. We're just looking at the sampling because we can control that. We know that so you might say, well, prices were going up. And I would say, well, why? I don't care. This could be 1,000 points. But if it doesn't impact the narrative or make any difference to anybody, I don't care. 1,000 points is useless. So Joe said something the other day, and I wanted to point this out, where he was in it. I don't even know if he's still in it, but he was in a trade that he was able to capture this move. And the point is that a 10, 20, 30 point predictable move is very different than a 100-point random move. If you can't predict it, it's not actual indication of volatility. It's nothing. It's meaningless. If an institution can't capitalize on a movement, that movement is essentially fluff. It doesn't mean anything. So there might be ways to track certain things. Maybe there's moves that could be measured in other ways, and that's okay. But from this system, if the move happens and it's meaningless, I don't care. I only care about things that are predictable. Now, I want to make one thing really important. Okay, and this is something you should always, always, always keep in mind. Are you ready? Because if you're not listening, you're going to miss something important. That's yo. You, not me, you, all of us as an individual, are greater than the institutional trader. This is a really important philosophy that you need to keep in mind for a good reason. This is not an ego thing. You are motivated through adversity. Maybe there's longer term or new institutional traders, but for the most part, if they've been at this for a long amount of time, like this is like a long time, this is just day in and day out. They're not actively motivated. You're better than them. And here's where this really matters. If you saw it, they saw it. If you understand it, they can understand it. Did we see the market develop and have the bullish potential? Absolutely. We watched that yesterday. We saw it. We clarified it. People took advantage of it. There was a lot of things going on. So yes. Are the institutional traders taking advantage of it? Yes. If you saw it, they saw it. You just have to run that by default. You are able to do this. You can do this. You, on your own, without me, without anybody, you can do it. The reason you need community, people like me and everyone in the room, people to be hard on you, people to be nice, is because you suck at controlling your biases and emotions. You need a community to support you when you are falling apart. If you don't have a community, then all of your gains will get wiped out in one day when you're by yourself. You need a community as a net, just like you need a family, just like you need friends. You need people to capture you or catch you when your emotions are falling apart. We can all tell when you're pissed. We can tell when you took losses. We could tell when you took profits. We can tell when you're feeling FOMO. We can tell when you're about to throw your... You type it, any trader who's been at this for longer than a couple years can read it in your words. It oozes like goo. We can all smell. And that's okay. Let us see that so that we can catch you. I've made mistakes and I've had people say stuff. I've seen traders make what I think are mistakes and I try to catch them. I try to say stuff. I want to be hard on you so that you can save yourself, because the biggest detriment to trading is your emotions, because you're alone, because it's just you. And so you can make these horrible world decisions about the world you live in and nobody's going to stop you, and you lose all your money, and you were doing so well, you need to share it. Okay? So it's important that you share stuff with us. I try to share, and maybe Diddy Kong says he smells it. Maybe I'm being emotional. I try not to be. I try to be objective as possible, but I make mistakes. Hopefully the community calls me out on it, or at least criticizes what I have to say, or questions me about things. And that's okay. Dissent. Do it. Tell me I'm wrong. That helps me. It helps you. It helps everyone. Okay, so liquidity sampling. I bring all this stuff up because this philosophy is not just simply thrown together. It has to do with people and what people are. It's a big deal. You need a community. Institutions need a community. They don't trade alone. There's not some smart guy in an office somewhere all by himself in front of a computer as an institutional trader, and he just does what he wants. That is not how they operate, because they're humans. They work in communities. They call each other. They see each other. They work in offices. They communicate. They know the value of community. So this is a rudimentary part of liquidity, and I'm trying to explain this so you can understand how this all works. When we get a liquidity sample, so let's look at this one, the most recent bearish sample. There's our sample, there's the volume, you see that? So you figured that out. So right there we get the sample. We get price start to move favorably, and you see tension starts to move along as well. That arrow is poorly pointed. So what we could see is that the institution went out and they rippled across stocks, impacted the probabilities start coming down, prices start moving down. Now, why would the bulls step aside? So we have the bullish sample right here, just following that. You see that? Bulls come in right here. You see that? So the bulls come in. So the question you need to ask yourself, why didn't the bulls just come in and pop this out of the park? Why didn't they just knock those bears out? Why? Because that's not how you play a game. Just wiping out your opponent time after time. Let me give you a little something you might think is useful. When animals play with each other, there was a research study done with rats. And what they found was that you get like a big rat. This is a rat. Those are his whiskers. And he's the big rat. I know it looks like a cat, but it's not. Look, see his short stubby legs, it's a rat. He has a long face. And then you have the little rats. Well, they found a couple of things. They found that the little rat, that the rats like to play, because play leads to cognitive intelligence, and the play was in the form of wrestling. Did you know rats wrestle? They wrestle each other and they try to pin each other on the back. And in this research, they found that the little rat would come ask the big rat to play. And you would think, why would they do that? Wouldn't you want to win? No, the objective was to learn. It was intelligence. But they found that if the big rat didn't let the little rat win 1/3 of the time, the little rat stopped asking the big rat to play. This is really important. If you don't let your opponent win 1/3 of the time, or some of the time, they stop asking to play. And what happened was that the big rat had no friends and lower cognitive development. This is a big deal. There's a T somewhere there. Because now the big rat was in charge, but had no friends. So the big rat doesn't get to dominate the group. So essentially the thing the rat might be after, which is I never want to lose, gets sabotaged if the big rat is a big dummy with no friends. The other rats will take him out. This happens in chimp groups and lots of groups. It's a big deal. If you want to continually play a game as the dominant player, you have to let the opponent win. At least sometimes. You got that? You must. You guys saw me make jokes about this the other day. I let my son win a third of the negotiations, even if he's wrong, because I want him to continue to try to negotiate. Because I think this is true. I see it every day. I'm calling you rats. Yep, that. So why on earth would the bulls, who have total control of probabilities, allow the bears to come in and push the market down? Why would you do that? Because it's more important that the game continues than that the winners never lose. It's significantly more important that the game continues. And you also have to remember, these institutional traders talk, all of them, all the time. These are not isolated people. These are in big groups. They communicate office to office. They negotiate. They sell liquidities, your orders. They're all working together. Why would you let the bears win, you idiots? Oh, wait a second. You have to if you want the game to continue. Too much success by one side causes the other side not to play, which stops trends dead in their track. The only way to continue a trend without an opponent, so here's what a trend would look like without an opponent. Where did the opponent stop? Right there. Because nobody wanted to play. The only way to do this is to increase wealth. That's the only way to drive that up further. If you can actually increase the amount of value that a security or a basket of security has, which would mean the market cap of the entire market would need to increase. That's the only other way to drive a market in a direction, increase or decrease. So if you're not changing the market cap, which in my opinion, printing stimulus drives stocks up, wink, wink, because stocks are priced to a percentage of your income and your value, not... Anyway, we'll talk about that later. So you need your opponent to win some of the times, or they quit and you stop being able to drive a trend. And markets are better at driving trends in adversarial market conditions than they are at creating market capital. Sure, we can bring some money into the United States. Sure, if Trump puts tariffs on China and destroys their economy, that would drive our stock market up as market capital increases from investors just finding places to put money. Sure. But most of the time, that's not the case. 99% of the time, it's adversarial growth. You're trying to destroy somebody to transfer wealth, and that's what causes trends. Most of the time, that's what we do all day, every day. Sometimes it's not. Okay, so we see the bears get a sample here. What's important is that right here, you could see this accelerated up. Whoop, right there. So right here, we know the bears... I was going to write dumped, but I'm going to write unwinded. Got that? Bears unwinded here. Who are the bears? We saw them this morning. Do you remember yesterday into the close? What was the point? We need to trap in bears and see the bulls run those bears out. It was more important to capture bears than anything else because that AAA trade had a lot of sentiment impact. If we had lost that AAA trade, we would have a problem. We saw the bulls come in and hit yesterday into the close. You remember that? They picked that up. We saw them defend daily tension. You remember that? So the bulls are here looking to act, not just looking, they were actively buying into this AAA trade. We knew that. But the way to keep a trend going is to trap your opponent and pump tension. That's the goal. So this morning, when the bears came in and sold the open and the market pushed up against them and they almost impacted tension, but price just moved against them. It was very clear, in my opinion, right here in the morning, the bears were trapped and the bulls were doing it. What brought this up? It was bullishness. Our whole goal was just to trap bears. We did that swimmingly. And so the bulls didn't wait for liquidity. They just were like, yay, and they bought it. We have seen the bulls come in, pick up a great trade, hit it, go ahead, do what they need to do to build the structure. Then we liquidated those bears, all the fun and all the trimming right there. We got them. We got them. There it is. The market leans up, samples the bears twice. I'm just looking at them as like the same sample. So I'm looking at it from here. I'm sort of ignoring the first one. They get liquidity from the bears. Remember, after the bears came in, got liquidated, the bears tried again. What are you doing, bears? What are you doing? So you need to stop going, these are algorithmic things with some solution. There's no solution here. There's no, oh, because of X, that leads to Y, which leads to Z. Sort of, but this is socializing. This is a game. Why did these bears come in and play again? It's like, dude, what are you guys doing? Look at their impact. They had like no impact. They leaned the market down right into a bullish sample, and the bulls hit again. That's twice. The bulls destroyed the bears today. And then if you look at yesterday, it's more than twice. Well, look at daily tension. We got this up right here, right? It pushed through. The bears did the bears defend daily tension today? No. Did the bulls defend it this morning? Yes. I haven't even gotten to the current events. Are you seeing the color, the flavor of today? Because if I can communicate to you anything, because you guys were having questions, it's not about picking apart the nuances of the tools. It's saying, how do we track liquidity? The real skill that you need to learn isn't necessarily how to interpret every data point. It's how to look at this like a game. If you can go, oh my gosh, the bulls defended daily tension. The bears got trapped. We had a AAA trade set up yesterday. The bears got liquidated. The bears jumped in again. They leaned it down and the bulls hit again. If you're sitting there going, this has this taste to it. What's that? Oh, bullishness. That's the flavor. That's tasty. You're doing it right. It's about seeing that story that's going on here so you can understand their behaviors. So then we get up to the highs, and what happened right here? How come the bears came in? Why did the bears come in here? What's the deal? Why didn't we just shove this up and liquidate these guys and pump this up higher? I don't know. I don't have a great reason for that. I can tell you that the bears got liquidated, and then, that liquidation could create some open interest theft. We've seen this before. We saw it yesterday with the bulls had some open interest theft in the lows. But I don't actually really know exactly why the bears decided right here. That's not important to me. What's important to me is that I pick up the flavor of the day. I'm like, oh, this is bullish. Like, the bulls will act. And so I think right here was absolutely the best trade of the day, unless you were willing to trade this. But I think if you were willing to trade this, you already got in yesterday. So you could call the open the number one trade of the day, but I think that if you were willing to trade a daily and you were picking up on the narrative, you should have already gotten into the market. So I think the number one trade for an intraday trade was this move right up to the highs. I think that was easily the best trade of the day. Why? Because it was bullish. It was predictable. You knew the bulls were going to come in. We knew the flavor of the day. We knew what had been going on. We knew that this not only that, but this was coming back, and it was basically testing where the bears got liquidated. It was just a good, easy trade. You could have popped in there and moved up, taken your money, been happy with a couple of points, and said, I got into a trade that made sense. It fit the narrative. It was great. Did you need to catch a move that went 1,000,000 points up? Well, no. This fit the narrative. So now we're going to move forward. I wanted to bring up all that because so Alex is bringing up yesterday, I mentioned if we gap down. The reason I mentioned that, if you watch the video, maybe I was unclear. I wanted you to understand the risk. I wanted you to understand why it was important, more than usual. If you can't understand that, you don't really understand the risk. And I think this is a big deal when it comes to risk taking. I want to talk about 3 types of risk taking that I think are prevalent. You have aversion, which is not the default, it's the idol. We idealize people who have no pain in their lives. Your life is so easy and wonderful. You must be amazing. It's idealized. Then we have the victim, which is the people who are suffering pain and it's not their fault and they're sort of helpless to feel that pain. And then we have the risk takers. These are the people who look at pain and push through it. They're the ones who say, I see pain and suffering and I'm going to do it. They face the pain and they go through it. You can try to avoid it, which will cause you more emotional pain than you could ever realize. You can let it happen to you and blame other people, or you can turn and face it. These are really your only options with pain and suffering. When it comes to risk, if you don't know the pain and suffering that are in front of you, you can't actually face it, which means you're not actually taking risk. You're being a victim or you're being risk averse. In either case, it's not good. So I like to point out all the risk. I love to see what my problem is. If this were to have come down today, it would have turned that AAA trade upside down. It would have created something really bad for the bulls. And that was the risk. But you cannot have growth without risk. I love to know the risk. I love to know it because it tells me there's potential for growth there. Lots of risk, not like your stop loss is wide. That's not what I mean. I mean, in terms of sentiment, means you have the potential to really do something great. So yesterday when I brought up that the market, if it had come down, that the bulls would have screwed up a AAA trade and that would have had some implications. It was important. The other reason was that so that you were ready. I can't have a bunch of traders who, when the market doesn't do what everybody expects it to do, run around with their heads cut off like chickens. Like, what do we do now? I needed you to say, oh, it gapped down. Here's where we're headed. I needed you to know that so that you instantly knew what was going on. It was for preparedness. The market gapped up or moved up. We knew which scenario was playing out. You absolutely should have known exactly what was going on at the open. It should not have surprised you. We covered it. I covered both directions, the importance, what a AAA trade setup looks like, why I thought this met those qualifications, what I thought was going on. You should have not have been surprised by that. The risk was the fact that it could have not worked. It didn't. Risk doesn't mean that you're going to lose. That's not what that means. Okay, now let's get to right now. Let's talk about why the bears, I think the bears were allowed to win, these guys. They were allowed or permitted. Well, I think that, one, the Federal Reserve is talking, and that's always a moment to take a step back and think about it. I don't think institutional traders give a crap about the Federal Reserve talking until like 10 minutes before they're actually going to be talking. I think they just play it normal until right before. I don't think they actually care. I think it's you and me who care. Because for the most part, if you're highly connected at the top, you probably already know. And if you don't know, you have an analyst who's pretty good at his job. And you pretty much know what's going to happen. I don't think they're surprised. We're surprised. And they act surprised so that we don't feel dumb. And we keep doing what we're doing. So why were they allowed to do that? Well, I think that a zero test looks pretty good, which we're getting right now. So here's the question. Will the bulls show up and defend this zero test? Are they going to pick up tension? And this is the question you have to answer. All this analysis comes down to right now. Are the bulls going to defend? Because if the bulls are going to defend, price is headed back up and we're seeing an opportunity. If the bulls are not going to defend, then the bears are going to get motivated and they're going to, this is a pivot. And there's 2 parts to a pivot. You need to, 1, figure out what a pivot is, where it is, when are things pivotal? And 2, you need to figure out the outcome before it happens. Those are the things that matter. And the harder one, in my opinion, is figuring out where the pivot is. Where is it? And in my opinion, it's pivotal right now. Not because of price, because of tension. It is pivotal. So are the bulls going to buy or are they not? Think to yourself what you think is going to happen. I'm going to get from here up till now and hopefully paint a picture that I think will help clarify whether I think the bulls are going to come in and play or not. So first we have the bears come in and they hit, and they do great. They hit, push the market right through the bulls who fail. So you have the bears, good job, bulls fail. The bulls get pushed down, and we saw tension accelerate right here into this. And we know, or we believe, that the bulls have probably unwound their position right there. Now let's take a look at today's positioning. We have the bears right here off the open who did a terrible job. Let me get in a little closer so I'm going to move this down. There we go. So you kind of see, in the way that I position this, it's like, well, how do you decide? Well, I look at the trapped orders and I look at the bright bar. You see the bright one? The bright one is just the last one. And then I mark about where the close is. That's it. That's all I'm doing. So the reason that last bar is lighter is just to help you see where that it ended, and so you can kind of see exactly where that bar ended. Sometimes it's not clear. So that's where the bears got trapped. Let's take a look a little further back. Here's where the bulls got, in my opinion, liquidity. So we'll mark that out as green. And I'm going to make these solid because they're positions, not stops. Okay. And then I think there's a really, 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 really difficult, I would say really, really because it was difficult, bullish position down here. And maybe I'll make that like a light yellow so that you understand that was a difficult position. It was not a nice clean cut position, okay? So these are the positions I see here that are important. Why are they important? Well, I like the people who are losing money because those are the people who pay more than I like the people who are making money. So we know the root position here for the bears is right here. We know that they got trapped here. So let me ask you a question. What do you see going on here with the bears? Just overall, what do you see going on? I see bears adding almost aggressively to a loser. That's what I see. I see them, we could even track this here. And then we have one right into the close here where the bears got a sample and there's a little bit right there, or, right there. Do you see bears selling at worse and worse and worse prices? Because that's what I see. I see that. Overall, just sort of meta. Okay? So how do you get, and this is and I told you yesterday this is going to be a topic. Here's the question. How do you get a bear to move his stop higher? How do you do that? How do you go about getting somebody to scoot their stop out of the way? Now, the way that I came to this conclusion, I want to make this clear, is it worked on me. Not just once, but over and over. And through documentation, I realized this was a methodical process to get traders to move their stops. So that's the question in my opinion. How do you get bears to move their stops higher? How do you do that? So I think that a lot of going up into about here was that. And the way you do it is simple. You get somebody into a trade, okay? And I want you to review your memory because this is how it works. You get into a trade and that trade goes like this. And right here you have slow pain. Frustrated, you're upside down. Right about here, you start chart flipping. That's where you start flipping through all your different charts. You start looking for people to sort of support your bad choice. What's important about this is that I think that what chart flipping would look like on the internet is essentially just internet traffic increasing in trading communities and stuff. Okay? So you get the slow pain where it's like, no, it's fine, it's okay. And then you go, oh my gosh, I'm stressed. You start chart flipping or looking to others for help. Then the market does this. This is emotional juicing. It's where the market goes sideways and lets you basically sit in a little prison and think about what you've done. Then you get the most important part. The market drops. And right here we have, I always called these the drip and rally, is what I called it. But this spike down gives you hope. You say, oh, good. Oh my gosh, good. I was right all along. And this hope basically relieves you of all your stress. You're like, oh, good. You let go. The market slowly grinds like this. And then it shoots up and makes its way like that. So this right here moves too slow to notice. Because you have hope, you don't notice that it's slowly working against you. You're like, it's okay, it's okay. It's just gonna retrace that drop. I mean, it's just gonna retrace and then head back down. And then before you know it, it starts moving up. Now what happens here is because of this right here, the most important part is the hope. You know that this is going to hit a profit target that is at least 100 times your normal target. And the way you know you're getting screwed over, are you ready? You are tracking a profit target way bigger than normal. This is standard. The thing that will tip you off is that you are looking for a profit target that's way too big. It's way too big. You're going, oh my gosh, I'm so used to 10 points. Here's what you're doing in your head. You're saying, oh, I lost 5, I lost 3, I lost 7. Oh, and this is a plus 100. It's going to wipe out all my losses. Plus I get a plus 7, 8, 9, 10, 15. So what is that? You get a plus 85 points on top of it. You're like, good thing I was right all along. Do you see the problem? You're not trying to make money. You're trying to be right, you douchebag, you jerk. So when you're tracking profit targets that are way too big, you're trying to say, I was right all along. You're way too concerned about what your freaking family thinks about you and what your stupid friends think about you and what everybody thinks because you're so worried about the shame of losses that you're scared to death. It's social fear that's killing you. This hope gets you to say, because of an 85-point profit I know I'm going to have, there's a way out. It's okay to take a 60-point loss. And this is where it's important. You make this equation. You equate loss with profit target. This is a huge issue. You say, it's gonna go, I'm gonna make 80 points, so it's okay to risk 60, and you can bet they're gonna get your 60. This is where you screw yourself. It's when you feel hope, and this isn't really hope, but you think it is in real time. You feel hope, you're tracking a huge profit target, it's gonna balance out all your losses, it's gonna give you huge gains, so it's okay to risk more. This was the goal the entire time. That's it. Okay? So how do you get your opponent to scoot their stop higher? You convince them they're gonna make ungodly amounts of money with hope. Hope. You got it? Have you been there? Of course you have. I didn't put this together out of nowhere. It was the process I was constantly being fed through for years in the beginning. I thought it was analysis. I thought my analysis was bad. So I would do further analysis. I would learn some calculus from 0 to n. And let's do the calculus. Let's learn the math. Let's learn the indicators. But it turned out the thing that was screwing me wasn't really actually trend lines or regressions or the math. It was the fact that I was constantly put into a state of hope and moving my stop wider and blowing out all of my profits plus some in one day or something like that. And you always end up at the end of the day in the same situation. I had money this morning. Why did I do that one thing? And you sit alone thinking about this over and over and over, and it never occurs to you, this was the goal. Not the analysis, not the statistics, not the trend lines, not the supports, the pivots, the channels, none of it. Not the Bollinger Bands, not the value area, not your volume profile. It was to put you in a situation where you feel this way over and over and over, because that's what all of you are going through. I've never met a trader who doesn't look at me say this and go, how did you know? I know because this is the goal of the market. It's not a coincidence. It's not even causal. It's intentional. It's beyond cause. Because if you're feeling this, you moved your stop further. So this is the goal. You've all been there, and if you haven't, buckle up and get ready for some dark days. I can't save you from yourself. You won't believe me until it happens to you. And then you'll go, holy crap. That's what you'll do. So let me ask you again this question. After we cover how do you get your opponent to move their stop? Why did the bears come in right here, driving this down to a daily tension zero test? Why did the bulls step aside? Hold on, a little boy is yelling to me. Consider what you think now. Okay, I'm back. And Alex, exactly. That is spot on. And I want you to note something important. I'm a little passionate about this because it has a lot of... traders are not clean-hearted people. We have huge scars with deep, dark memories. We have things inside of us that are just these little tragedies over and over. This analysis comes from the excruciating pain that it costs. I am 100% convinced that by the time you figure out how to trade profitably, you'll say to yourself in that moment, I'm not sure it was worth it. You need enough pain and suffering in your past to actually modify your future. Now, the only way around that is community. Either you learn enough pain and suffering to moderate yourself, which it turns out the amount of money you'll lose in order to earn that, let me tell you the equation. Are you ready? You need to lose exactly 300% of all of your money. That means your current account balance plus your next account balance plus your next account balance, because 3 times is a trend, not 2 times. And until that you realize that you're the fool, you will not stop. So either you have a community of people who will support you, or you can do this alone and lose everything you have 3 times. Okay, so I would prefer the community. I also think that traders, people in general, are intelligent, and that if you give them the opportunity, they can contribute in an intelligent way. And I think the community is the easiest way to get around losing all of your money 3 times, all of it 3 times. So in the end, you'll look back and you'll say, I had to lose everything 3 times before I figured out how to day trade. There's other types of investment that are not going to tax you this much. But if you want to learn to trade like this, and you want to do it by yourself, which I had no teacher, I figured this out all on my own, you're going to have to look back and say, I had to ruin my life more than once. I had to not quit when the rational and logical thing to do was to quit for years before you go, oh my goodness. That's the cost. It's everything. You also have to pay a huge chunk of your psychology. You have to lose your mind for a while. It's expensive. Community's the safest way to trade without having to pay the real price. And I think I can develop people into valuable, little valuable people, little valuable traders. You can spout off what you think. It helps me. I can see what you think because you're not me. That means I get better information. I can't see what you see. And obviously you see things that matter to you. And that's important to me. I will not listen to you if you're being a sheep. I listen to people when they're telling me their thoughts. When you have thought about something for a little bit and you say, this is what I see going, I love that. I want to hear your thoughts about markets and everything. But if you just say, I drew a trend line, here's a simple trend line, and that's it, you just drew it on there, I don't care about you. But if that trend line's on there for a reason, and you say, here's what I think, and maybe you provide, okay, I'll listen. So I just want you to know that this is a big deal, that all of this has to do, this is very well thought out, and it has a lot of reason to it. So why do you let the bears come in? Because life sucks as a trader. That's why. But you need the bears to win now and then so that they keep playing. But you also need the bears to push the market down now and then to move the bears' stops. You can think of this, you could also think of this as if machine learning, the algorithm was tasked to take in these data points. And the fitness model was increase money, optimize profits. The machine learning algorithm would come back and say, you know what, every now and then we need this to go down for it to go up. That's what the algorithm would tell you. Now it would tell you it and you would say, really? Okay. And you would blindly follow that because it's right. But we know why. We know why you need a market to come down. We know that. Okay, so now that we've gotten through that, okay, that psychology that we just went over, all the pain and suffering, all that fun talk, was to explain why this happened. It gives us an idea of what the bulls are looking at as well. This is what the bulls see. They say, we're going to get this to move up further. Now, I don't know that it's going to here. That's just arbitrary. It's just to make a point. Okay? Why did the bears come in? And Alex answered it. I think he understands what I'm getting at here. Why would you let that happen? You also need to recognize that right here, there's risk for the bulls. What's the risk? You let the bears come in so we can cause this whole situation and they get too far. If you let the bears in, you have to take some risk. And so bringing this down could cause us some problems. Maybe the bears push it down. Maybe they get tension down and they get it under zero before you know, you can re-grab onto it. Maybe. So there's risk there that when you let them have control, you're letting them have a gun to your head, right? You're saying, here you go. I think they're going to screw up. But what if they don't? So there's risk. And if you can acknowledge that and you can swallow the fact that allowing a counter trend move increases or gives them the opportunity to potentially take you out. If you can deal with that, then you can finally start to understand how this works. We let them do it because we let the bears do this because it benefits the bulls. This helps the bulls. We let them do it because it benefits the bears. This is one of those almost win-win situations, but I mean, do you see how this works? This is important. You have to understand this. It works in all systems of analysis, all of them. Okay, so let's take a look at tension and see what we think. Do you think the bulls will defend daily tension? Heatwave, can you please talk about binary events and associated moves? Now, I want you to clarify. When I think binary event, and I think things, but I'm using a lookup table. So you say binary event, and I have a lookup table, and I'm looking up the word binary and event. And I'm coming to a third conclusion. So I'm going to guess that clarify what you mean by binary events. And yeah, I'll talk about it. So let's take a look. Decay moves down and under zero right here. And you see right there how it crossed under? And right when it crossed under there, just a little bit of crap orders came in just right after. And the bulls did nothing. Okay, now I think this is teeth. Yesterday we had ourselves the root positions, no teeth. Here. That and that. And today I think we have teeth, which means that you look for your entry point for the bulls, and then a lot of times it fails first. I'm not cherry picking, this is what I think. So we saw this entry point happen. It moved down, not entirely unexpected. This is teeth. This is the secondary position in this. And we have at that same moment, daily tension. You can see we're just barely getting up. So right at this moment, our bears are sitting, well, I would say the bulls were somewhere in here, but we're going to mark out the actual liquidity here. And the reason for that is because I think that they have flexibility. There we go. Got that? Now, if we move this down, I think too far, I think we'd have to go quite a ways before these bulls let go their position. That's what I think. I mean, I really think that this line might even be representative. Just like, we would have to move down to like here before the bulls really started to, I'm not looking at decay here. I'm looking at, we'd have to move this really pretty decently down. We'd probably be able to get some of that position leaned up, maybe here. My reason for choosing this spot is because I think it was pretty clear intraday what was going on just about here. You could have picked it up in the morning, but I think right about here it was pretty clear we're going to be moving up in terms of narrative. So I'm going to choose right about here, just on the other side of that is where you'd really have to go to get those bulls out. Okay, so we have these bulls, we have some teeth, we have our zero test, which so far is just sitting nice and flat. Now, right now, what are the bears thinking? Well, the bears think, oh, we got a position. Maybe even you could think maybe these guys they did hang on because they didn't get liquidated, so they got basically two positions, but they're basically one here. Now, if they can get that to move down and liquidate that position, we could get daily tension under zero. So this is what the bears are thinking. They want to get daily tension down and regain control of that. And they want tension to curl down and then tomorrow do that. This is the bears' idea. you come in and you take advantage of that, right? The bulls went, "Here you go, guys, go ahead." A sudden news drop. Okay, so binary events. So you mean things that are easy to define. It is or it is not. Like that was a huge drop where that was. So I think that in terms of news bars, I don't want to talk about news bars if that's not really what you're after. There is a moment. There's always a moment, and when I say moment, I mean a definable time. In my head, this is something this alludes to like a algorithm. Really, it's something you can point at. At the end of the day, it's like, what did your eyes see? And you can point at it right there. You could put your cursor over it and say this. And I'm going to guess this you mean by binary events. There is a moment in a trend or when an institution comes in that there's like a breaking point or something and things start to go. There is that moment. And that type of thing can be backed by a news event. It could be backed by all sorts of indications and all sorts of things. The point is you could say, oh, that's where it started rallying. But it tends to be, in my experience, that the point when stuff rallies, so for instance, yesterday we had, I think this was the spot to get in was with that little liquidity sample right there after everything lined up. The spot at which it rallies does not tend to correlate on top of when everything sets up. In other words, the narrative gets developed often long before or not at the same time of those events when things start to move. Now, if you're just talking about random things like a big spike or a big move or something like that just randomly shows up and doesn't seem to fit, a lot of the times a good old-fashioned spike down can help really stimulate some FOMO. And it leads to that whole scenario, lends itself to the scenario of hope, where you have a big spike down like this encourages these people and allows this to move up higher. I'm not entirely, I think that's what you're talking about, is those moments where things just happen that move, and there's two of them. One of them is after the narrative's set up, after everything's clear, after the things build, then you get a moment where that you can jump in and there's some risk, and then the news comes in and the things flare up and you get those things that happen. Then there's the ones that are random, or more than anything, they're counter trend or counter narrative. So if we're sitting here looking up and we get a big old bar down or something like that, a lot of times they could be random, but they sure do help the market continue the narrative. I think the more that you push things around without liquidating an institutional side, the more money's on the table. It's just good for institutions to move things as much as possible without liquidating anyone, and then run the market to liquidate one side or the other, because then there's more money. So I think they sort of build the buy-in on the table. Is that what you're after? I think you mean those moments where things just go almost for no reason. And if that's what you're talking about, then okay. So while you finish typing that, Miguel, John says, give your opponent hope allows them to move their stops and keep playing. Yes, John, yeah, you got that. Miguel, if bulls don't defend daily, the whole bullishness from the morning is not real. No. Things don't work. Well, maybe that could be the case. The bullishness from this morning came in because we were meeting the expectations. We had a bullish sample right at the close. We trapped in the bears. The bears got turned upside down. They got liquidated. The damage was done. They lost money right there. The bears came in. The bulls picked it up and moved. This is all done. The bulls are there. They got in. They did the damage. Markets just move forward. They just keep adding to the story. They're cumulative that way. So at this point, If the bulls didn't defend, what you should think is all of this bullishness is, if they start trying to liquidate that, essentially all of this bullishness is going to need out of the market, and it create some downside demand. And that downside demand would absolutely be in the minds of the bears. And that's why I think that they could get, if they were able to do that, now would be the time to attack. I don't think they're going to, but now would be the time to attack. All of that bullishness would turn into demand, downward demand. They'd essentially scrambling for the door, or they all want it at the same time. When you cut down the amount of time people can act, and you increase the amount they want to act, you have demand. And so in this instance, if we got daily tension under zero and they aggressively did that, liquidated a position, a lot of these bulls would say, oh my goodness gracious, this is going to be painful. And then we'd see a demand spike, and we could see a further slide than you want. So no, the bullishness is still legitimate, even if they didn't defend it. It's just that the bulls failed to defend. No matter what they did, they were unable to make it happen. And in the end, all that matters to investors, I tell this to my kids all the time, by the way. This is one they hate hearing me say. Nobody cares about you. Nobody cares about your crap. Nobody cares about your problems. They don't care about your enemies. They just want results. The investment world cares about nothing but results. You can tell me all day why and blah, blah, blah. All I'm going to look at is essentially a 1 or a 0. Did you or did you not? And that's how I think the investors look at the market. If the bulls can't defend daily tension, they didn't get results. I don't really care why. It just has to do with if they did. That's it. So I think this is a big, I say this to my kids so much, they hate that. So that's what would be on the table here. Now, I see that this got down to 0, and we're seeing it sort of hang out down here. This is not really the enthusiastic response that you want to see, is it? I mean, is this what you were wanting to see out of the bulls? If you're sitting here in a position from here, do you want to see this, or did you want to see it go boop and then come back up? Isn't that what you wanted to see? Right there. Isn't this the idea in your head? Right? And you're not really quite getting that idea. We could see it move up still, and you'd be like, that's okay, it was just, but this is sort of moving slowly. That's what's happening here. So now we can actually look at this and make a decision. What? Alex, I know you meant something else by that. Is there any way from you, I don't mean this to stab at your intelligence. I think you mistyped that. Is there any way from your charts to see that the bulls are defending the bears? Is that what you meant to say? Like, are the bulls fighting for the other side? Is that what you're asking? Okay, he said sorry. So I'm not sure that I have a good way to see if the bulls are defending the bears. Okay, so we have a pretty good idea, in my opinion, of where we're at. I think the market came down here with the intent to help drive up the hope in the bears in order to move the stops so that we have a bigger reach to the upside. As we got down to the low, we saw some teeth with our here, and it ran down. That's the teeth. And that happens all the time. And this whole teeth scenario, along with this whole scenario, got us back down to a 0 test. This puts the bulls in a little bit of a vulnerable position, but we've seen them defend it a few times, and I anticipate them to continue to do that. Oh, say, are the bulls defending themselves? Okay, so confirmation. Is there a way to confirm that they're defending? That's what you're asking. So he's saying, are the bulls defending here? Is what he's wanting to know. And if we take a look at tension, 30 minute, and 30 minutes the one I use, not daily, to determine that. Yes, all of this came from this. Aside for the fact that I was saying, why did the bears get the chance to come in? I think has to do with the hope model, or the optimization of profits, or how do you get your opponent to move their stop? You give them a little win that doesn't actually win. That's what you do. And then they win without getting any leverage or increase. And then you slowly move the market against them, and they numb themselves to the pain of loss. And it's because they can't feel it, they take more losses. So that, other than that, the rest, yeah, came from everything that I've said so far has come directly from these charts. So I don't see tension rising. I'm not surprised. Usually you don't see tension rising in the second position until there's some pressure on the counterparty. And our counterparty players for today are sitting here, here, and here. These guys have indications that they liquidated here, so this may not weigh in as much, but I think there's a lot of people stuck right here still, because people like to just run until the margin call. That's just human nature. We just love that. So these are the positions right here and right here, the ones that need to get pressured. So once we start to get a little pressure, I think we'll start to see the impact. So here's the way it works. It's like a feather foot. So if you go into the market and you fill across the stocks aggressively and you up the open interest, you would see tension curl. Like it would look like it would go, and you, as an egomaniac, might think, aha. But there's a problem with that. If you stroke your ego and you let tension curl from your impact, well, these bears are going to see that and go, holy shiz, and they're going to dump their position. And so we might see something like this. It would look like that. You impacted because you filled across the stocks, really aggressive, and it curled tension and you felt victorious. They saw you do it, they exited, so they're not holding a loss, so it shoots up based on that demand, that's it, and then comes right back down, and now you're underwater. You're in a negative position. That's the way it works. So if this moves too quickly, the second leg will go underwater. It needs to go slow enough, a feather foot, until these guys are feeling too much pressure to just quickly exit. Basically, these guys need to say, well, it's up to the market gods. You know, maybe it'll go against me. Maybe it'll do this, and then I'll get out. It won't. In fact, we see the market do this a lot. Moves up against their position. Let's say that this is their position, just because I don't want to draw a line. Moves up against your position, comes back to break even, and goes through it. And you don't cover because you're an idiot. And you think, oh, I was right all along. When you see a positive number or your DOM shows you little green numbers, your brain lights up with dopamine and you just leave your position open. When you should have taken a break even, but the market knows you won't cover because you're stupid. And it'll go, and then it'll just do this. That's what people do. That's why it retests. In my opinion, it's because people are dumb, and we can go back to them, and they'll even add to their position because you think you're right. So, but it never actually went profitable. Trades that are 1 or 2 points up are not winners. They're just there. Until it really moves and does the thing you expected, you didn't actually win. Until this moves up. And I think this will. I'm anticipating this is going to slowly make its way up. And the reason is this here was a drip. In other words, the bears got daily tension back down to zero. Their liquidity worked. It pushed out the bulls. In other words, it was like a windfall, but only in terms of structure, right? It was a windfall structural move in this, wasn't it? If you're a bear and you shorted right there, don't you feel like, yes, they took out these bulls, they won, they were able to move tension, they got daily tension down to zero. It was like, you guys did everything. It was a windfall structurally, but not really. So sure, it could turn into a windfall. And this needs to get moving here. I think that we need to get this moving. We need to get daily tension moving up. And I think that the bulls are being nice and patient. They got their setup they had the teeth, so and it shoved back down, and now that's moving on its way up. And so this to me looks like a secondary position. Right there, and I've said this before and I'll say it again because it's really important. Watch for teeth when it's a secondary. Not like this one or this one, which were root positions, because we didn't have like a lower rudimentary structural position. So now this one, you have to look for those teeth in the secondaries and the tertiaries and so on. And so what they need to do, and I think this is a need, it's not like a style thing. They need to get those bears to move their stops, because this will not continue higher. If these guys dump, we'll just get a quick spike and it'll be over, and then we got to reestablish, and that's annoying. So we need a nice slow move here. This is going to irk you because it's really annoying. If you're a buyer from here, I know exactly what you're thinking. Let me predict what you're thinking. I can hear your thoughts. You're thinking, why didn't I just, isn't it? Isn't that how you start? Oh, why didn't I just cover up there? This isn't worth the pain. And then you're sitting here going, okay, how far up should I put my break even? Should I have it here? You know, if it pushes a new low, maybe I should get rid of it. Why didn't I just cover up here? And then you'll follow this one up. This is funny because you're doing a straw man argument. You say, why didn't I just cover? I know you say that. You say, why didn't I just cover here? I knew. It's like you're providing evidence for this to be true, which is stupid. You're being stupid. So that's what you're doing. And you have all this time to sit and revel in your regrets. And what you should do is just shut up. Just shut the hell up. Stop indulging this nonsense. You need to look at the structure, make a decision, and act from that. If the narrative tells you that the bulls still are here, the bulls are still going to act, this was a secondary position, things are good, we're trapping in the bears, just shut up. Just shut up. Focus on the narrative so that you can hold. This is a hold. This is still bullish. The bulls didn't lose it. The bulls let the bears have this. They had to. They had to. So this is going to make its way up and then pop. That's what's going to happen. This is what's going on. And I'm hoping that really kind of going into this, explaining some of the philosophy, will help you see how to build these narratives. I already know. Okay? You're not going to like this. That a lot of you don't have the experience and the pain and the suffering to come to these conclusions alone yet. I see what's happening because I've been there. I know what it feels like to short the low, not just once, many, many, many times. I know what it feels like to buy the low. I know exactly what this feels like. Here's the low of the day. You're like, yay, and you buy right there and it does this. I know what that feels like. I remember once taking a $5,000 loss on the Russell. What was it? RUS? I don't know. It was the Y. It was not the YM. It was the RTY. That's what we call it now, anyway. What was it before? The TH? Was it the TH? Something like that? I don't know. I remember trading. I don't really like trade the Russell. I think it's like getting smacked in the face with a flimsy piece of tall grass. That's what the TF, that's what it feels like to me. It was like somebody took a really tall, wasn't a nice whip either. It was like this flimsy piece of grass and just, that's how the Russell feels to me, but that's just, it's just so all over the place and aggressive. That's just my opinion. I don't trade it that much, but I remember trading it once and I lost $5,000 based on this move. This was the hope. I mean, I just went right into it. This was the hope. Grinded until it ran my margin call. It hit my margin call, and then And then I was right. It was so great. I was able to lose and be right. And that's just how it works. I remember that one so clearly because it was the moment when I went, holy shit, this is every day. All the time. It's not a coincidence. It's not random. You've all done it. So be aware. So I came to this conclusion based on experience. I don't really know why the bears came in here. I can't point to why. I can't say because of XYZ. But I can remember why. And I can't point to that. I don't know. I can explain to you why I think that happened, and it's going to work, and you're going to be forced to wonder if I was right. But the reason I think the bears came in was because this is what markets do. And that's what I think. I also think that out of this and this, we have moved past really analysis. We're into the trust phase. And anyone who's followed me for a while knows what trust means. And trust is the moment where that you are just comparing everything back to the day that the past you version of you, because you are no longer this person. The past version of you wanted to get in, what the past version of you saw, what the past version of you needed. I think we're in the trust phase. I don't think we're in the ingest new information phase. We're not in the phase where we see a bear go like this and say, oh my gosh, is this broken now? I'm going, oh, the bears are coming in. Why are you letting them in? Oh, yeah. Screw them over. Because I trust the bulls and I trust myself. I trust myself. I have been doing this long enough. I have proof that I'm smart enough. Money proof that I know what I'm doing. I also believe that I'm a capable human being. I don't think I have any mental problems. I don't ever recall being schizophrenic, as far as I know, imagining realities that don't exist. I think I'm intelligent, capable. I'm just as smart as the guys at the top. They're not better than me. Their algorithms might make their lives easier, but it doesn't make them more intelligent. They might have better view of the data set, but I understand the fundamentals of humanity, what a human being wants. I know why these work. And you cannot eliminate the human from the equation as much as you want. Well, if we did, then we just get China's yen, right? It's the yen. There's no sense to it, just whatever they ask for that. So I am intelligent. I trust myself. I don't allow doubt in everything. I'm just comparing back. And if I start getting things that don't match up with the past version of me, with what he wanted, then I start thinking that the idea that I was trading is coming to a conclusion. Things start falling apart. This is going to work, and I am going to again say, I am a capable trader. I can do this. And the next time I will trust myself more. And in my experience, what trust is for a trader, don't trust my ability to spell. I think I've proven that I don't deserve that. What trust is, I've said this, and it's the tagline on my website, is trust is equity, but the experience is this. It's that the things you believe are real. Are there bears at the high? Or do you think that's just an analysis thing, it's just a trick of narrative? Or are there actually institutions who filled there? Do you actually think there are people in tall buildings with fast internet who got liquidated this morning? Do you really believe that they're hitting the broad market and impacting the probabilities? Or do you think that they're just fancy words, data points that have doubt to them? In my experience, trust is when you take the believe out and you say they're real. It's when you say, I got in, my analysis was right, this is real, there's real money here, it's real. And it's not that you say it, It's that it is real to you, like the pavement or the wall or your hands. They are there. It is there. If you're to the point where that is real to you, then you can start saying things like, because if it's just well, there's a data point here. What does that data point mean in the Markov chain? Let's see, how do you spell It's a K. The Markov chain, right? Like, how does that affect the Markov chain? If this is a chaotic event, what's the starting point so we can start to predict the outcome? No. You can start to say, why did the bears come in here? I know they're there. It's almost like you're standing in a room and a bear came in and you're like, what the fuck are you doing in here? This is the bull's bathroom. You can't say you were born a bear. You can't say that you're a bull inside and you're a bull trapped in a bear's body. You see the bear come in, you see that the bulls got pushed out, it's real to you. And if it's real to you, you can then actually let your social intelligence, the smartest part of your brain, start building narratives around it. But until it's real to you, until you trust it, it's real to you, then you're just following along instead of using your actual intelligence to say, oh my gosh, the bears are here. What are they doing? What are the bulls doing? Where are they? And you can see the people. And I've noticed that the human brain is amazing at following, like, especially women. You tell them a story with one girl who's in a love triangle with two boys and another girl who's jealous and then a parent who tried to stop it all. And a lot of times it seems to me that I have no idea who these people are. And I'm like, so the parent was dating one of the kids or so, what the heck was your story? And my wife is like, oh yeah, that second girl is totally going to get the boy. And the first girl is probably going to cry tonight. Or like she can keep up and she knows their names and stuff like that. So it seems like women are a little bit better at people narrative. But I think all human beings are good at general narrative. The fact that there's a love triangle is easy for everyone to remember. I think it's just my lack of interest in love triangles that makes it so I don't remember the names. I just don't care as much. My wife's like, ooh, interesting. And I'm like, sort of. Can I extract money out of this? If there's now TV shows with a love triangle over and there's stock market, I'm on board. So this is sort of how it is. You get this narrative and there's a big section of your brain just for this narrative and you are really good at it. You don't need me to teach you. But first you need to believe that there are bears here. And the way that you know is that your social intelligence flips on. Just the same way when you see people in a room, you're like, oh, she likes him and he likes her. And I could tell that this lady, we're all going to hate her. Nobody's going to, if we have a party and I said, hey, call everybody at the party or call everybody in this room and invite them to the party, I already know that you're going to accidentally forget to call this person right here. Another part of social intelligence is your ability to accurately predict another human being's intelligence, their IQ. And you guys have probably all heard this story that if they had a bunch of people in a classroom, they said, get up and talk about the news for a minute or less. And then they had a bunch of people do that and the classroom judged their IQ. And then the individual judged their own IQ. And then they all took rigorous IQ tests and something. And the classroom was like 90% or something higher. You can judge other people's intelligence, and it turned out the people judged their own intelligence obviously way higher than they actually were, or they were just way off. You're bad at yourself, but when you look at other people and you say, oh, these bears, oh yeah, they're winning, but they're stupid. You want to know what? You're right. That was a bad play. They should not have played into it because it's about to eat them for breakfast. So it's important that you recognize that your social intelligence is significantly more advanced than any of these tools. It's just that you can't see the people. These tools are trying to bring the people to you. So you can look at them and go, why did you do that? Why didn't you do that? Where are you? That's the goal. It's just we're trying to look through the data to see the guys sitting at their computers. We're trying to understand their intentions. We're trying to see their hand, who they're talking to, what's going on. Once you can see that, if you could sit in a room and watch all the traders, I'll bet you could just look at the backs of their heads and based on their body language and maybe how much they fiddled a pen, you'd be like, oh dude, he's stressed. The market just dipped. He sold the low. And as the market rises, the pen's flipping goes faster. And you would just see that out of peripheral vision and be like, oh yeah, I'm going to buy more. And the faster he flips his pen, the more you buy. Because you're socially brilliant. You're amazing. See? Yes. No, you're right. Miguel said, can't trust easily turn into hope. When do you question your trust? I am interpreting trust here as being slowly built based on creating an accurate narrative. Yes. Yes. It's building that. So I say trust after you build so you build your narrative, then you have your opportunity. So this is going to be like 5 minutes or something. The opportunity is always quick. The clarity, it's the clarity spike. Things get clear, so you build your narrative, you get your clarity. This also, then you move into trust, and trust is not a state of shutting your eyes. It's a state of opening them. It's a state where that you're saying, do the bears coming in here, is that okay compared to my narrative when I had clarity? When I had clarity, is this okay? And I think, yeah, this is fine. When the bears sold this morning, is that okay with the clarity, the things I wanted when I entered the trade? And I'll tell you why, is because holding a trade, a discretionary trade. We're not talking about algo, we're not talking about procedural, we're talking about discretionary behavioral analysis, which is what this is. It's momentum behavioral analysis. Holding a trade means that each time you have a point, a counter point, all of you musicians will laugh with me. Each time you have a counterpoint, it's a new trade. Because if you didn't know that this was a trend, if you didn't say this can support that, or essentially at this moment, you said, okay, I think this is a AAA trade, it's going to run a multi-day trend. That's the kind of thing it is. Then does a counterpoint, is this going to stop you? No, actually, we expect this. Does this stop you? Does this stop you? Does this stop you? Does this stop you? When, and for me, trust is the phase where that as long as you're getting what the past you expected. So I'm not building new expectations. I'm referencing the one that got me into the trade over and over and over and over. And that's really what's happening. I'm not shutting my eyes and saying, just hold. I'm sitting here going, does this match that? Does this match that? Does this match that? I do this all day in my head. So if you were to like stick a speaker in my ear, you would hear me think, okay, if the bears win here, is that okay? I'm asked, like I'll sometimes get a little nuts and like talk like past me. Is that okay? And then I like act like past me. It's fine. I just do that. But I say that all the time. Is this okay? Is this what I wanted? It's not, is this what I want? So that's sort of the difference for me when it comes to trust, is that I'm trusting my past self. And I think equity is trust. We have to have trust in order to build a market. Otherwise, all the counterpoints break you down. Because if this worked and liquidated these bulls, if you had no trust and you had no narrative that said this was a AAA setup, and you didn't see that the bears got blown out, then this right here would have said to you that the bears just beat bulls. And you'd say, that's a problem, oh no. But if you're looking at the structure, you can tolerate these counterpoints, these counter flags, these opposing opinions, because you see that the longer term perspective here is still holding together, and that's okay. The whole point of trust is it makes you accurately, but it makes you rigid. You're somewhat inflexible because you're no longer recreating expectations. You're using the one that you use to get into the trade, and you hold it. This is a big, 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 big part of holding live trades. Because if you don't understand how to trust yourself, I promise you, you'll cover too fast because you'll get scared. You'll see this situation where bears come in and win would have crushed the market on a day before everything set up. It would have just crushed it. So the significance changes here because I'm in a state of trust. I'm not referencing this alone. I'm constantly filtering it through my expectations when I got into the trade and what I was thinking at that moment. I'm like stuck in a moment of time. I'm stuck there. And until this betrays me, until it betrays my expectations, like we had the entry right there, right? And then it pushed down to liquidate it and then ran. Well, we got teeth. I expected that. Well, if the teeth had led to a bearish sample and the bears were able to push that down further and curl tension down, I would have said, WTF. This was fine, but this betrays my whole philosophy. So as long as it doesn't betray the things that I think, I continually am stuck in the past. At the moment when we bought into that long, I'm continually stuck there, and I will hold my position until it betrays that. Once we start to see betrayal, things are not working the way a trend should work. It's not holding out. I'll dump my position. And at that moment, let me make something very, very clear. If this had betrayed me, here some way and convinced me that the trend was deteriorating, and then it leaned up, and then it continued, I would say this is a huge problem. And that the bulls were about to get, I wouldn't counter trend trade it, but the problem is that you're betraying the thing that makes a trend, and I will have absolute serious criticisms about that trend, because you can't run a trend without people who trust each other. I argue that it is impossible. Let me present to you that if you and me, let's say you and me, just you and me, the two of us decided to, you guys know I like to have a couple of little poker chips. Let's say there was the bank invest a little money, you invest a little money, I invest a little money. Okay, there's three of us. Three little monies. Let me change the color more. I have a black one. There we go. Three monies. There is an implicit trust between all three of us. But if at a moment I thought that you were going to do something that I did that betrayed my trust, that becomes a problem, because the bank, we'll say the green was the bank, depends on our working together for them to get their money back and make money. Me being in there depends on being able to trust you. So if I leave, the bank leaves, and it's just you. It is very valuable to you to not betray me. So if this tried to set a trend and it betrayed the people it was working with, the institution, the bank, is not going to back this trend. Like, they're not going to be like, yeah, sure, dump money into that. So they'll pull out. And the other bulls saw that you just betrayed them, so they'll back out. Well, in this instance, pushing markets takes capital. It's more expensive than any one person could really do. Just think of it. Okay, you go out with your trading account and push the market up. Good luck. Let me know when you do. We just need to get it through the highs. Go ahead. Now imagine you had a $1 billion account. How far do you think $1 billion is going to go to pushing prices up? So let's see. You come over here. We'll open some main stocks. So how many shares of Walmart, Twitter, Microsoft, Amazon, Zoom? Now I watch that because everybody uses Zoom. Google, Facebook. How many shares of these? Remember, you need to buy all those, plus all the stocks I don't have up here. So how many shares do you need to purchase to drive it up? Trust me, $1 billion is going to seem like a little pile of money really fast. No matter how big you are, to drive a real trend is expensive. And secondly, do you really want to use all $1 billion? You can't do anything else. You're just stuck. So you need other people. You need to say, this is a good trend, I won't betray you. So that other $1 billion accounts come in. So that other $1 billion accounts come in. So that you can hedge a little, maybe do some other stuff. So yeah, Alex, not far. You need a lot. That's why trust is so crucial. So if these huge $1 billion accounts betray each other, was there one account that decided to shove the market down an extra 10 points? Sure, you could do that with $1 billion. Sure. Won't last. You could probably do it. But why? You'll betray all the people you're trying to trade with. Maybe you got a better price, but you've lost the financial backing. You've betrayed everyone who's on your side. You are all alone. See how far you get. So betrayal is a big deal. That's how I determine it ends. So I know this is a lot, but I'm really trying to get into the psychology here so you can understand my thinking. How do you keep from moving into hope? And it's that you're constantly doing this. What did I want here? Is that okay past me? Or is this what I wanted? And yeah, I think this is just fine. And so this is how this is all going to work. The hard thing is, when do you exercise trust? This is going to be the hardest question, and I'm not going to cover that right now, but I think yesterday we had a good trade set up, everything happened, and we moved into trust. Now that we're in trust, that's how everything I've said so far, this is how I came to those conclusions first, where I sat and just did this over and over and over. And you get out of trust by looking for when the market starts to betray your past expectations. And the way you keep from getting into hope is that, for the most part, hope is when you get into a short position and it comes up and you're losing money the whole time. And it's how do we get a loser to lose more? And if you're winning and you're concerned that you're in a state of hope or something like that, you just put a break even on it, go to your community, say what you think, and try to get feedback. The easiest way to rat out emotions is to go to your community, tell them what you think, and maybe just ask for feedback. Because you'll never be able to see the cracks in your argument or the flaws in your logic better than when you're sharing them. You'll share them. Trust me, when I started trying to teach people about this, it became really clear that the system I was using was pretty good, but I had cracks in the way that I did it, because as you say it, there's something about putting it out to words and then sharing it with another person that makes you go from A to C. Oh crap, there's no B. And you realize it. There's no B. I need A to B to C. And then you have to work on that. And then you have to then you have to figure it all out. If you are concerned, share. Share with your community, because those concerns are good to have. Rat out your emotions by sharing with your community. And you should be saying, wait a second, Logan, are you doing live streams to help yourself? Yeah. You're dumb if you think anything else. Yes, this is a very selfish thing. I'm sharing with you guys. Now, I did do a lot of work and I have formulated this pretty well, so I can do this. But your listening is helping me. It does. If ever I get to a point where I have a hole in my logic, I will stop and I will reassess that, and I will literally do nothing for days. I occasionally get in my car and drive for 4 or 5 hours and just ponder, because I can't make money if there's holes in my logic. Are you crazy? I don't want that. And I don't want my whole livelihood dependent on a bunch of sheeple paying me subscriptions, because then my whole job is just to teach you misinformation so you keep following me. And my misinformation just needs to be just good enough that nobody loses money, but nobody can make money, because then you don't need me anymore. That crap, it's freaking bull crap. I don't actually want you guys to depend on me. But I benefit from sharing a lot. And I think I could make some intelligent traders out of you, and that will increase my opportunities, which means I can make more money. And it is far more profitable for me to have 1 or 2 more opportunities a week than it is to collect subscriptions. Because the cost of subscriptions means every day, all day, you guys think I owe you something, and I don't owe any of you crap. And I don't mean that in the mean way. I don't. And I don't want you depending on me. as much as possible. I know that you have to learn, so I'm willing to do that because I think it's valuable to me. But I don't want subscriptions. And there's a reason, because I don't want to be tethered to all of you for some stupid, I mean, what is that? Like 7-8 hours a day? You expect me to sit here 7-8 hours a day, just open and ready to answer all of your emails because you pay me $50 a month? Like, you guys can't afford me. You can't. And I'm not going to ask you to. You guys would have to pay me at least $30,000 a month to want to sit and do that. Just make that clear. So if one of you wants to do that, let's go ahead. I'll take $30,000 a month and I will sit here and answer all of your questions 8 hours a day. Sure. But at the same time, I'm going to be honest with you. It take me about 3 days for me to start resenting sitting here and being like, I can do this on my own, goodbye, and quitting. So I'm not interested in it. I'm interested in community. I think we can round up a bunch of really smart people and basically operate like a fund, not a fund, but where we all contribute, come up with great ideas, and you guys do it, and we do it together. I don't want to do this by myself. There's nothing lonelier than making a bunch of money. If you've done it, you know what I mean. There's nothing there. You have an account with a bunch of money in it, like your bank account. You go, cool, I got a bunch of money. And then you go, now what? You're right, Diddy Kong, there was 100 people watching, but I love my independence more than I love money. I love my freedom. I like to spend time with my kids. I like to sleep when I want to sleep, read when I want to read, do what I want to do. Sometimes I go on vacation for a month, just on a whim. I love my freedom. I got a garden in the back, trampoline I get to jump on with my kids whenever I want. I get to watch them grow up. I can't think of anything more valuable to me. If you guys can come up with something more valuable than that, by all means, you have my attention. But I can't find anything more valuable than being free to do whatever I want, whenever I want, and to have my family here, to be just an arm's reach away all the time. What else is there? You're right, but Diddy Kong, you're missing one really important thing about this being cumbersome. I expect everyone in here to start doing my job for me. Are you kidding? You guys are all going to start YouTubing your videos. You're all going to share your stuff, and I'm not going to deal with everybody. Are you nuts? Secondly, people who like my way of teaching is not everyone. They're Joe, and I've learned this with Joe because me and Joe are like night and day. He does things different than I do. He's like I like to call him, he's like the sun. And I've told this to him before, so I hope he's not offended that I share this. He's like the sun. Joe is always there. At the same time, he's dedicated. He's that way. I'm a creative person. I show up when I show up. My output can look like this, but then my spikes are really high. So I get these moments where the output is greater than anyone you've ever met. But the rest of the time, creativity usually just creates a bunch of nothing. And so I'm very flexible and fluid and opinionated, but in like a little different way. And Joe is like the sun. He's here every day. He's dedicated. He's determined. He'll yell at you to your face. I'll criticize you in a strongly worded letter. So me and Joe are just very different. And the people that will be attracted to Joe are not the people who will be attracted to my way of teaching. He shares his way, and he has his own opinions about things. And I don't always agree with Joe. I don't. But he's not stupid. And the fact that he has a different opinion is very healthy for me. I listen to him because I've traded with Joe for a long time, and he does different things than I do, and I take it seriously. because he's different. I need it. I need different people for myself, and because that helps our community grow. We can't be the same, or the best we have is the one output we have. We need to be different so we can get multiple outputs. And every once in a while, one of those outputs is going to be way better than what we have now. That's how it works. We all need a Joe in our lives. Matt, that's perfect. We do. We all need a Joe in our lives. And Joe will tell you how insane I am. And I'll tell you how great Joe is. And we're just different. And I think that's a big deal. I would love it if we had more diversity in personalities and opinions, because those diversities, when they come together, we get this better thing. My goal isn't to create a community of followers, is to create a body of people. And I think we're going to weed people out. And sometimes, yeah. If you, Heatwave said, BaconTrading, are you using us as an indicator? And yes, sometimes. If you're going to be emotional, I will let you be emotional and track you as an emotional sample. And I'll just assume you're doing what everybody's doing. And we do that all the time. So yeah, sometimes you can use, if I get emotional, feel free to use me as an indicator, and feel free to let me know that my money has found a new home. I shouldn't be doing that. And I need to learn. So go ahead, make the jokes. It's fine. Yeah, Joe had an idea in his head, and Joe and I have worked on building ideas. Joe had an idea. I don't know what his idea was. I don't actually need to know, because I know that Joe knows how to look at a market, and he had an idea in his head, and I'll give him the credit he deserves. He got in 3 days ago, back on Friday, last Friday. He held over the weekend because he had an idea. And I know exactly what he's doing. It's that you can trade analysis, but the most money is in idea trades. When you get an idea and it's the right idea, that's where the money is. And I'm teaching you guys slowly how to look at liquidity, build narratives and stuff like that. At the end, what I'm doing is, this is all how to build the right idea. He had an idea and he went for it. Ideas are the profitable thing in trading. That is really what it comes down to. And whatever that idea encapsulates, depends on the idea, depends on the market. March 7 Radio says, make it not about trading for hours for a handful of dimes. We get a baby in our prime. I use the head count at Stock Market Live as a main pain. Yeah. So, okay. So Mac 7 Radio Intercept says he uses the head count Stock Market Live as a market pain indicator. And that was part of that hope model. When people get to the point where they start, I call it chart flipping. They start flipping through all their charts. They're like, where's the answer? And then they hop on their social media and they start, guys, this is totally not, they start like looking for more information. It's fight, flight, make friends. And traders will, first they'll fight by getting into trade, that because they think they can. You can't fight a market. Then you try to run away. Like you're like, okay, it's fine. You run away. And then you try to make friends. And making friends is the chart flipping phase that I think happens. So, okay, so do you see what's happening here? And if you want, make sure you go back, watch the video. I really did try to put in all the information that I really think, after years and years and years and years and years and years and years of doing this. So this was a great time to see how this all built. I tried to go over what I think was going on. Yesterday, we talked about how the AAA trade set up. We saw the entry happen. It took off. We got everything we wanted this morning. Everything's working out. We got ourselves a drip and rally. We've trapped in some bears. We're going to get this good. So this was a really good, the last 2 days. I think you should maybe not completely rewatch them because they're a little long, but go through to the main points and take a few notes. Think about it. You need to internalize this stuff. Take a minute in silence and think about it. Review yourself, review how you feel. Because at the end of the day, the most important thing to a market operator, to driving things up or down, for a trend is convincing you to lose more money. Just hitting your stop isn't enough. And so you should review how you feel about that. So you're the indicator that matters the most. And I can just share my experience, because any trader who's been trading for longer than a couple of years has a lot of scars from emotions and memories that help regulate them. It's a painful thing to learn. And I honestly do not believe, let me make this clear, I honestly do not believe the market is trying to teach you. I hear traders say this thing that is the biggest lie I've ever heard, that there's some learning curve or there's a tuition that you pay. That is wrong. It's a lie. When you have a slave, you don't beat him as a tuition so he can become a slave owner. Are you stupid? You beat him to shut him up and extract the value that you can get out of him, and you do not value them as people. They are a herd of sheep. This market is not trying to teach you. It's trying to abuse you. That means it wants a sustainable amount of pain over time. And this is the addiction model. It is the whole mechanism of addiction. It wants to addict you to losing money over time. Taking all your money now will probably, if you sat down day one, lost all your money, you'd be like, this was the worst idea, I'm never doing it again. Because that, we all know from gambling, that's not how you do it. That's not how a casino pulls you in. We want a nice, steady stream of loss from everyone. It is not teaching you. The only thing the market is teaching you is that you do not want to think the way you think now. You need to change. There's no end of the road. It will abuse you till the day you die. The moment when you have paid your tuition has nothing to do with the market. It has to do with the fact that you let go of your pride and your ego and you stepped back and you got real with it. And you realized that this was beating the snot out of you on purpose the whole time, and it will never end. And then you can actually start to learn how to trade. There's no tuition. It doesn't want to teach you. It doesn't want you to learn how it works. It wants to take your money over time, and it wants you to keep coming back. And when do traders trade? When do traders trade? So let's see, January. So there's January. What happens in January? That's right after taxes, right? So here's taxes. Let's just talk about this. This is important because a lot of you are probably going through this. January. Do you trade in January? No. Do you trade in February? No. When do you trade? Well, probably like March to May, because that's when your bonuses come in. Right? That's interesting. So what happens in the summer? Have you ever heard a trader say, oh, summer trading is the worst? Why would summer trading be the worst? Because that's when all the retailers got their bonuses and recharged their trading accounts. So the market does fun stuff, and then the summer hits. All these bonuses come in, so let's just eat them. And then everybody loses their money by, I don't know, the end of summer, isn't it? Nobody's trading in December. You can't trade in December. You can't lose your money during Christmas. You have to buy toys. So you quit trading around what, like October? Because you're losing all your money. You pull a little out. The markets start to move. Tax season comes in. Then the markets can move for taxes or whatever. Then they respond to taxes, and then bonuses come in again, and we start it over. Markets are slow in the summer because retail traders recharge their accounts with bonuses that come in the spring every year. You're what matters. Your account is what matters. You do. The markets even prove that. We know that summers are always different, and it's because retailers show up, and so they just start punching everybody in the head for a couple months until all the retail accounts are empty and they're like, oh, I'll try again next year. That's why they move. That's why it happens. And if you don't think think that's what it is, well, just consider your own life. You get bonuses in the spring. That's when they get doled out by everybody right before the company has to do taxes. It's file their taxes. They distribute all the bonuses, file their taxes, the retail accounts go up, the taxes go into the government, and another reason is that, have you ever noticed that a lot of companies use the company paychecks? So they get to take a big old chunk of your paycheck, I don't know, 30% of your paycheck, and they get to take a 30% of all paychecks. This is stupid. And invest them in whatever they want. So during the time when you don't have any money, the investment companies are accumulating interest. And then when you finally, Paychecks has no money because they distributed bonuses, they paid taxes, blah, 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 blah. They don't have any money anymore. So the investment firms slow down because that money that was on hold for taxes all year, which is bajillions of dollars, gets paid out, and then all of a sudden retail traders have money. So what do you think investors focus on? Interest rates or screw over retailers? Well, there's no money here, so I don't know. To me, this is just like, duh. When you think about it, Paychecks has all your money until they pay taxes. So obviously pay attention to that. But then they don't have money and retailers do, so pay attention. You just go to where the money is. So this is really why the market's seasonal. It has nothing to do with what you think. Everybody's telling you, which because of blah, 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 blah. And I'm like, well, maybe, yeah, they play a moment. But I mean, once you find out that Facebook lost investors, what happens? You do one thing, and then it's over. Okay, so here's Facebook, here's that one thing, but then it does a bunch of other stuff. What about this? I'll tell you, this has to do with the seasonality of markets. It's the other stuff. That this one piece of knowledge led to one event, and then it's over. So it accounts for one thing, and what about the rest of the day? So in my opinion, news events get calculated in really quickly. Markets are extremely efficient. Let me give you one piece of self-evident truth, okay? I'm just going to show you something real quick here. This is my computer. I have enough processing power in this little machine here in my house to run a beast of a machine learning algorithm that could trade the market. I could pump out some stuff. Me, alone, in my house. I don't represent people who have everything. I represent somebody who bought a decent trading computer, a good one, for a lot to me as an individual. I'm not an institution. This is just me. And I could write an algorithm that could easily run a Bitcoin. I could do that on my computer, no problem. I have enough broadband internet speed to host a server and host an exchange. I could do it. The piece of evidence that I think is self-evident is the fact that I am nobody and I can do it. What happens when you put billions of dollars behind it? Oh my gosh. We have faster computers now. We don't have to deal with lag. They're perfectly efficient. News comes out, it's calculated. So, yeah, actually, how'd you know that? Heat wave? He just guessed how much I paid for my computer. Yeah, that's how much I paid. Suspicious. What are you, like a computer builder? He probably looked at my... How did you do that? You tell me. He figured out how much my computer cost. $8,000. It was just under $8,000, actually. That was just the computer. And then I have all the monitors. And then I got all the fun I mean, I didn't need all this stuff, but if you're going to make a YouTube video, you might as well do it awesomely. I don't know if I'm doing it right, but awesomely. So, well, you have to understand, I didn't just get this for trading. I wanted to be able to trade, live stream, video capture. I was doing editing. I wanted to be able to program while running Thinkorswim. So I had like all these other things I was looking to do with the computer, not just run Thinkorswim. You don't need this much juice to do it. I also haven't, I probably shouldn't tell you this, but I also have intentions to attempt. I've been studying Visual Basics, coding C++. I'd like to build a virtual representation of markets, virtual reality. And you needed some pretty decent juice to build virtual representations of markets. I've seen a few people kind of try to do it, but I would just love to see like a really good version. The problem that ends up being is that the people who write code aren't the people who actually sit and watch markets for 7 to 8, 10 hours a day. So they do a shitty job. You know what I mean? They just, if I did it, I'd be like, I know exactly what I want to see. And I think that traders would like it. Yeah, the Xeon, I would, so I got the new i9 supercharged whatever processor stuff. But yeah, 3D interpretation of markets, yeah, and put the VR on. And my reason for that is, I have a good reason. It's not just because it's cool. It's because I think that a more visceral and vibrant, representation of the market will allow your brain to do better. Just like when you go outside, maybe you can detect the sun isn't quite as bright, that the air is a little something. Maybe you can sort of detect the barometric pressure, and you sort of get the sense by being outside. You're like, it's gonna rain, isn't it? And you're right. It was just, you were in it. Where if you just saw the data, maybe you could figure it out, but there's just something more real to being in something, kind of thing. So, Alex, no, I didn't know. I picked all the pieces out. I wanted to get some stuff done, so I paid a guy to assemble it for me. After watching people assemble PCs and realizing they can be a little fickle, and there was a little bit of a learning curve, I was like, I'm busy. So I actually had somebody put it together for me. Probably, I think it added like $300 or $400 to the price tag. Yeah. I have the, are you talking about me, Pablo? I have yeah, it's the 2 GPUs. I have the 1080, the GTX 1080s. I have them in SLI. I can put them in SLI if I do like machine learning stuff. That's sort of useful. You want to boost your RAM for that, but yeah. And really the thing that takes all the GPU and everything is live streaming and capturing, getting that all down so that I could stream it out in high resolution over the internet while running these charts. It's just a lot of demand on the computer. I didn't want to worry about it. I want to be able to just do the things I wanted to get done and have it be as awesome as possible. So we just move forward, it's cool. And if I'm going to work at a computer all day and sit in front of a machine all day, it might as well have RGB lights and have colors. It might as well. I gotta be honest. Having your keyboard light up, yeah, it's awesome. I mean, and I sit here easily. The last 2 weeks I haven't put as much in as usual, but the past 2 weeks. But the past couple of years, I'm easily like 10 hours a day typing, and you get these nice keystrokes on. I mean, a laptop's keyboard compared to this, oh yeah, you're right. It's a little ego. I like it though. It's fun. It feels good to sit down in a nice workspace. But also, every time somebody asks me to sit down in front of their computer and they have one monitor, I just feel like somebody put me in a straitjacket. Okay, I want to look at 2 websites and watch all my charts and have up a chat and live stream. Can you do that? They're like, I have one monitor. It really, you can never go back. Those guys who have a wall of like 50 monitors, they'll never go back. Like, just never. Anyway, we should get back to markets. I've sort of wandered off the trail talking to you guys about stuff. Okay, so you can see where we're at. You see that nice sweep right there? You see that? This looks just like, oh, this is sweep. Remember I was drawing the pictures, sweep. Just look at that. It looks exactly like, this is the one that would always get me. Now what happened is right here at the low was where your position was sitting. It just was always true. You would have a position. I don't know where that position came from, but it'd be about right here. You'd be sitting in a short and you'd watch it come right back down to your position. And you would see something like your account balance with your rotating profit loss would say 0. It would go from red to like the gray, but not really turn green. And if it did, you didn't exit. You didn't exit. Because people who are losing money don't take break even. Gosh darn it. They only take $1 million and that's it. They'll say, I'll only cover if I get my profit target. But once your trade is upside down for a sustained period of time, all you are is holding a loss. Oh, yeah. Yeah. I did put up all the specs that I had because people would ask, and I thought, oh, I'll just put a place so that you guys can see the stuff that I'm using. But keep in mind, I got this machine so that I could do a lot of different things, not just watch markets. I wanted to be able to live stream, edit videos while markets were open without like issue. And it turns out you can pay for that. I have actually considered getting more RAM I use a lot of my RAM. Doing this right now is eating, but I mean, video compression is a beast. So I'm almost 50% on this, and this is actually pretty low for Thinkorswim. 14,000. Usually it's at like 23 or 22. When markets get really moving, this will pop right up, and you'll be like, "What happened?" So I've considered getting a little bit more here. My GPU is up, but I have 2 GPUs, so they're attached, but they're not in SLI. So I'm using 37% of the total capacity. So probably like 15 on each or something, 16, 17 on each. But yeah, I know it's for gaming, but good luck finding if it's a trading computer, you're going to pay an extra $100,000. The only kind of computer you can get that's performance is gaming. That's it. Apparently either you get a computer from Walmart for $200 or a gaming PC. There's just not, or you can get server PCs that come with CPUs designed for machine learning and data and stuff like that. So either it's that kind of computer, a gaming computer, or one from Walmart. I was like, well, I guess I'll get a gaming computer. I don't know. Its RGB lights are awesome. I gotta be honest. If you have the opportunity to get some RGB lights on your computer, just go right ahead. You'll be pleased that you did. Totally unnecessary, but it's like a racing stripe. It feels faster. I don't know. Oh, if I could make any recommendation to all of you, get a mouse with freaking buttons on it. Holy cow. At first I was like, this is kind of dumb, but oh well. I went with the Razer brand because Razer has cool stuff. You go there, they're gaming stuff because that's all you can get. But I have a bunch of buttons on my mouse. And if I can make any recommendation to somebody who's going to sit in front of your computer all day, get a gaming mouse that has a bunch of buttons on it. I have 1, 2, 3, 4, 5 extra buttons, 6 extra buttons on my mouse, and I use all of them all the time. I have them set to do things to my charts. I have them set to open programs. So for instance, when I go to screen capture, I push a button on my mouse and then I screen capture. When I go to edit the screen captures, you guys are wondering, how do I edit? I use Snagit. So I pushed a button on my mouse. It opens it up. I can edit it. I open the editor. And doing this, here's the editor. So doing this, I'm constantly screenshotting stuff, documenting things. I can run programs. I don't know. If I had one recommendation, get a mouse with some sweet buttons. Yeah, 12 extra buttons. You don't think you're going to use it. And then you set a couple of those buttons to the crap you do all the time. And you're like, I can't go back. You just can't go back. So, sorry, you guys are getting me to geek out. That's not what this was supposed to be about. Okay, so you can see this drip and rally. We got down these break-even boys, which probably maybe this group, some in here, some in here, some in here, didn't let go. And this is just stereotypical, like, awesome drip and rally. Yeah. Wait, Gabe, did you say you shorted? He might not be in here. I think Friday was tough. Gabe was asking, he said he was short on Friday and then got long to Monday. So let me show you. I always liked, in my head, like, you just post freaking charts, please. So short here, long here. So, you know, Gabe's got, I just want you all to understand Gabe. He does whatever the hell he wants. And we love that about Gabe. He's got his own thing. He listens, he understands you, but he does his thing. And he's got his own thoughts and opinions, and he's just always been that way. Gabe's superpower is doing whatever he thinks he wants to do. So he did his thing, and he was able to get some good stuff. Okay, can you, Heatwave, you asked, can you please explain big are chopped and how executed? What? Can you please explain big are chopped and how executed? No. What? Oh, orders. Basilisk. That's a Razer mouse, isn't it? How orders are chopped and executed, how that works. At least how I think it works. Okay. How orders are executed. There we go. Chop. There it is. Drip and rally. That was just awesome. So this one was conceptual drip. We had all the things, and then rally, and this was price drip and rally. Nice sweep, pushed up. This is just standard stuff. Like, to me, this whole afternoon has looked nothing but bullish. I have not for a moment said this is bearish. I have considered what the bears want. And I tend to, when I'm bullish, to focus on what the bears are after. And when I'm bearish, I tend to focus on what the bulls are after, but you all know that I rarely get bearish. I get more, either I'm bullish or I'm not participating. Okay, so how big orders are chopped and executed. Okay, so first, I'll get to yours, Alex. You said, while your charts tell us bulls and bear participation, does it tell you roughly where ES will go, like where we are going to break a previous high? Okay, I'll get to that in a second. The first one, how are big orders chopped? Okay, so there are two types of big orders. Here's the institution, right? Here's the exchange. These are all the wires that go out to trade with everybody. So this is their connectivity. There's the people who play, and they have big orders, and there are the people who do not play, and they have big orders. These guys have more money. They're like 5. These guys have a lot of money, but then they also are infinitely backed by whoever it is that does that. So there's two groups here. The first group plays, they have a bunch of money, but that's their capital, but then they're infinitely backed to do whatever they need to do. And they're the market operators. So there's their orders. The ones that really make a difference are the ones who do not play the game. These guys pick up the telephone and they call. This is an old school phone. I'm going to do one with a dial on it. There. They pick up the phone and they call and they tell them what to do. Hey guys, I want to fill an order here at this price. And these guys Have to fill it. So that's the very first step, and it's a big deal because these characters need to generate liquidity to provide back orders for the guys who do not play. The guys who do not play have all the money and they're mostly in control. That's important because you have two types of order filling. You have agentic, where that you're approaching the market with an agenda. I need this down or I need this up. We see this all the time. I don't track it. I probably should. You could criticize me on that. But if you pull up an order book, a lot of times we'll see an order way out of the money and it just rips through analysis like it doesn't even matter. It'll go up, fill the order, and then we go back to normal. That's agentic trading. Somebody made a phone call. I want this filled. I don't care what your little world of indicators says. Do it. And they do. So if you have an order book and it's got, levels and stuff, you'll see little orders here and there. All of a sudden you'll get this order way up here and it just goes up and fills it. And you're like, you didn't set that up. You didn't play it. You just did it. And they're like, well, we had to. So what? So there's this type. And that's the people who don't play. They made a phone call and you do it or you're fired. And so the operators are like, okay, let's get this done. Nothing you can do about that. And the reason I don't really track that is because it's outside of structure. And I want to put this in a way that you understand. I can read the market with these tools. I can tell when the market's lost its head. It's just stepped outside of reality. Nothing matters. Who cares? I can see that. So here, these are my charts here. I can see that here. If I take my eyeballs, and I mean my physical eyeballs, and I look at these charts, I can see it. Then if I take my mental eyeball, and I am considering all the data and everything, and I'm doing that in my head, I can see it. But if I pull up another chart that has large orders all over it, ends up happening is that you'll see something like a big order, and it pulls your attention away from the narrative. And you end up paying attention to these large orders, which you do not know. You do not know if that order will pull the price up or not. Really, the way to tell is how long the order's been sitting there. If you have an order that's been sitting right here for this long, there's a really good chance it's going to get filled at some time. Or if the market just starts moving up towards an order and you see that order's been sitting there for hours and hours and hours and hours and hours, and as soon as it got pended, the market's basically just moved towards it. What happens is you start to see that, and it starts to be your focus, and I'll tell you why it screws you. Because it's easy. You can look at it, you can see it, and you're done. When I had those orders up, I ended up subconsciously, I prefer easy things. And I don't want to do that. I do it this way because it's the hard way. But it's more accurate, in my opinion. I tend to I feel like I can understand the market. But when you pull up something that just shows you the order, it's hard for me to do the hard thing. You want to do the easy thing. So I want the hard thing. So I don't track it because I think I can see it in real time through the analysis. I think I can predict that it's headed towards an order or something, and it's hard to come to those conclusions if you can just constantly be looking over, being like, oh, you end up mixing in these data points that I personally was having a hard time making all that useful. It wasn't increasing my knowledge. It was just creating a distraction that occasionally would skew in a way that wasn't helpful for me. Yeah?
Your house.
Whoa, okay. Oh, and you blew up my house that I made in Minecraft?
Hmm? Just look, and then it's turned to holes. Go in Minecraft and look what's happened.
Okay, I will after I'm done, okay? But you have to rebuild my house that I made in Minecraft. I thought we were neighbors.
And I thought you needed to play Minecraft. And
You know how attached you can get to a little house in Minecraft? He blew up my house apparently, and he's excited about it. Okay, I'll play Minecraft with you for a little while after I'm done. Okay. 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 So Miguel says, you want to do 3D models of markets, have users use it, take advantage of their natural intelligence, and use their emotions. How's that going to work? Okay. So Miguel asked about my idea for 3D markets. Okay. So I'll tell you. Yes, Pierce. Okay. Do you want to go keep playing Minecraft, and I'll come get you when I'm done?
first.
Second. I can play it second. First, I'm going to finish this live stream talking to these traders, and second, I'll come play with you. I'll play with you after we're done all night till you have to go to bed, if you want. Okay?
Okay, but don't.
Okay, give me a hug. Oh, I love you. Go play your game.
Okay. But can you move these?
No, you play in there. I'll come get you when I'm done. So when it comes to the 3D markets, it's that when you go in to look at data, you have price, you have volume, you have tick count, which this is just think or swim. These are really the same thing, but it's the way you aggregate them. So price, volume, tick count. Then you have some more abstract concepts like something like the average true range or volatility. Then you have options. Then they have things like gamma, delta, blah, 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 blah. The point is there's so much data that I don't think two-dimensional charts do a really good job of expressing it, and that a three-dimension, which really is more than three-dimension, there's a lot more. We're in like the fourth, fifth dimension because time and I think you could look at it and we could do a representation that lets you look at that data without just a two-dimensional view of it. I think it's quite three-dimensional, that you'd get a much better sense of markets. Thank you. You fixed it? I need a bed now. Can you put a bed in my house?
Big one.
Okay, a big bed. That's why I think that virtual reality could really provide some opportunities. There's another dimension to markets that I think is a big deal, and that's peripheral. We don't get peripheral markets real well on our screens.
In your house.
Oh, thank you. So like if oil is just cratering like we saw a little bit ago. For me, that was a peripheral thing because I don't usually focus on oil. So the way that I deal with that right now is I use these charts, which they allow me to just at a glance look at charts. So if one of these craters, it's not my main focus, but I kind of want to see that this is a big, decent sized move. So I use some pattern recognition algorithm to just give me a peripheral view. But if you actually had it in your peripheral, I think that would just allow your brain to put it all together really well. I think it would be great. So just ideas. So that was one of my things. I haven't done it yet. It's a lot of work. Okay, so Phil Danner says, so oh wait, hold on. I had another question that somebody asked. Orders. Oh, so orders. We were doing orders. So the orders come in, the guy orders it. That's why I don't track the big, large orders. I want to make that clear. Those orders will just show up on the books and they happen. Those are the non-player guys who just make a phone call, say, do it. The order shows up on the books and the market operators are expected to just go to the order. Okay, so the other type is the big player order. And this is a big deal. And so we talked about this. Open interest. So the delta of open interest, so we could do the delta of open interests, if this delta shoots up too quickly, price will react. We'll see is go whoop. And if you've ever traded a penny stock and not accidentally, but filled too many shares, you can drive the price. If it's a low volatility penny stock, you can actually push the price up. What ends up happening is that just because price moved up doesn't mean there's a trader there to let you get out with a profit at all. You could probably, most of us could probably round up, I don't know, $100,000 account, go slam a penny stock, and you could move it, but will you be able to exit your penny stock with a profit or what? And that's where the issue comes in. You see it more on the smaller scale, but on a large scale, you need a place to get in and you need a place to get out. This is not a target. It's a person. And I'll tell you, a target it can imply a person, but it can't guarantee a person. Now, in an index, obviously you can fill. They're highly liquid. But the point is, it's good practice to know who is going to let you out. It's not good practice to know where. So when the orders come in, you build the open interest here. So if this is time flowing that way, you build the open interest here. You offer the open interest to the player, the institution, the big player. If they consume it, then as the thing moves, you need to know who's going to pay you. That's why liquidations are so good, is because they let you know who's going to pay for you to exit. And a lot of times with a liquidation, which is about to happen, these guys are going to get liquidated. We'll watch for this to curl, give us a nice curl, and then you say, oh, these guys paid for here. So it's not often that the person paying you executes their order the same time you do. They often execute at a separate and many times earlier time. And then the market runs to them. So we know these guys will pay, and that's at a different time. So one of the things that you want to think is that when I buy, there's a seller on the other side. So my win is his loss, right? It's sort of arrogant to think that all the participants execute all their orders at the exact same time. That's just not. Buyers buy when buyers buy, sellers sell when sellers sell. The point is that there's some sort of inventory here. And there's an inventory of liquidations up here. There's an inventory likely of liquidations down here. There's an inventory of people stuck. And we look at our inventory and we say, under these bullish conditions, what do we need to pull out of the inventory? And that's kind of how you say that's where it's going. So the orders come in, the institution wants to fill. They'll say, I want. Then the liquidity is created. Then the liquidity is consumed. And then the market moves. And then the same thing on the other side. They say, I want. And this wanting here is the intent that we're after. It's what we're trying to capture. So the orders come in sort of like I want the order. The market operators, the liquidity comes in. Now, who creates all this liquidity? Well, it's in an index, it works like this. It's all the stocks in the exchange. So one thing that most traders don't realize is if you trade a stock in the, well, I mean, I could say the S&P 500, but if you trade it in the NYSE and you see prices moving, so you buy into, I don't know, big name Apple, you already lost your money. The market didn't take your order and go, okay, what do we do with this? The market took where you'll exit. They said, where's the margin call? Where's the stop loss? And with intraday trading accounts, a lot of times, let's say you have a $100,000 account for intraday trading, right? Well, the market can't move enough to stop to margin call one intraday trading account. So they impose like a 9-point stop. And the reason for that is essentially to simulate margin calls. So then your position has a margin call or a forced exit. Then they have the discretionary exit. Right there, which is usually, or pretty much always closer than the forced exit. And so what happens is if you trade into Apple, your order gets bundled up into a bunch of other things that represents an SPY contract. That gets sent over to the SPY exchange traders using the, what do they call them again? They're registered users. This is what they call them. A registered user is able to convert immediately stocks to ETFs, to futures, to just wherever they want. They bundle those up into here. The SPY has just sold that over to a player. So this is the actual exchange. This is the player. The player is moving it down and they're about to take profit. They exit. And your position has just barely started to move by the time they're dumping their position, and you already lost your money. That's how stocks work. Now, if there's no player, or if the stock that you're trading has something going on, like whatever, it's not always true, but it's often true that if a large order comes in on a stock, it can matriculate its way upstream to the index, and then even further into the futures, and then branch out into options. So that's how those orders work. So I don't see a difference really between the stocks and the futures and the index. They're all connected together. But typically we just take advantage of the stocks because they're spread out. They can't see each other all getting pummeled at the same time. So they just don't realize the market's just beating them all to death. And that's where a lot of the money comes from, is from stocks. Most people, you say, oh, I trade equity futures. They're like, oh, what's of that? Like, it's, never mind. If they don't already know what it is, I just changed the subject. Okay, so that's how the orders work. They bundle them up, then they go, and they can go back and forth. So they're not different. So I think if you're just looking at volume in the ES, you are looking at likely 1/3 of the volume of the picture. You need the ES, the SPY, and then all the stocks. Because I think they're basically all the same. That's pretty much how it works. So that's how those work. The second question here, which I know I'm being long-winded, but I'm hoping you guys can just rewatch these videos and get these. While your charts show, does it tell us roughly where the market's going to go? Yes, these charts tell you roughly where the market's going to go. And the way we know where the market's going to go is pumping tension. So when I say we need to pump tension, how do you pump tension? I should basically hear everybody yelling, liquidate the counterparty. Yes. Well, liquidate your opponent. So we saw a little bit of that here. When the bears came in, right? There's their signal, there's the volume, and the bulls did nothing. Where was the market going to go? To liquidate these bulls. Did it? Yes. We saw it liquidate the bulls right into that. It was this move here. At that moment, if you were just trading that, you would have closed your position and said, I just captured basically liquidating the bullish position. It tells you these guys want to pump tension. They want to change the probabilities of the market, and they do that by liquidating a counterparty, which when the bulls unwind, they have to cover stocks and stuff like that, and so it causes the probabilities to shift. So that is that. In this instance, you say, well, where is this going to go? In the morning, you say, well, they want to pump tension. So they pushed until the tension pumped, and it went swoop, and then you see it slowed down. So once you take out your counterparty, you say, we need the bulls say, we need more suckers. So we need to find some bears, and we did that here. They were able to feel a little success, and then we run them out. So then you could say, well, where would we go to find more suckers? And it was this. So essentially, after we liquidated them, the market leaned up into bears because the bulls need bears to drive the market structurally. So we got to lean that up, and then once the bears came in, because the bulls right here, the bulls did a little bit of impact, the bears came in, we needed more suckers. So the objective here is to say, who are you going to take out? And the whole objective is to get as much control of tension as possible. The second objective, so the first is control tension. right? We saw this yesterday. We want to control tension, so they pumped it up. They got everything over. So this turned, the bulls got control of tension. The second thing that happens is when tension gets too hot. It was too hot. And you want to alleviate the counter tension without losing control, and that's elasticity or a burn off. So first you want to pump tension, then you want to burn tension off without losing control. So these guys pumped tension, then they burned it off, then they pumped it again. This was just perfect two-legged move. So they pumped it, burned tension, then they pumped it again. So you look at today, you could just look at that pump tension, didn't really burn it off, but 29% is not too bad. We could tomorrow just keep going. I mean, maybe if we saw it at negative 60% or negative 75%, then I'd be like, whoa, we have got to cool off this tension. But 29, no reason. Don't worry about it. If the bear had control, let me bring up Diddy is bored. So here, I pulled up the trade trust group charts. So you can see the bear got control here. They both do the same thing. They want to pump tension, burn tension, pump tension. But it's over and over and over. And you see through these areas here, the bears didn't really pump tension super well. They didn't really get it favorable. And the bulls kept defending, right? And then the bulls tried to pump tension, but they just didn't do a great job here. This is a nice pump. This is a nice pump. You go pump, burn, kind of back and forth based on tension. So it's the same for both sides. They want to do the same thing. But first you have to get control, and that means pumping it. And control means, are you ready? Control means this. There's only one L. That's a big fat L. Control means this. It's difficult to break in a day. Okay, so this was bearish control because it was difficult for one day to really break that.
For this.
Sure. I'm gonna grab this boy a plate for Dora. It's missing. It's missing, son. Can I give you a different plate? You want a yellow plate? Okay, so that's what control is. Control is when that you can't be broken in a day, or at least it would be hard to do in a day. So obviously you can always break it down in one day, but the fact that the bears got it so far means they had control, but it also meant they wanted to do some burning. So I think right here, you know, this was a good indication the bears had control. Do the bulls have control? Well, yeah, they got a pretty good control, but they'd really like to get it up a little higher so that it can't. So the bulls want to pump tension as far away from zero as possible so that they can say, you can't break us in a day. That gives them control. They have the control to give permission to the bears and all that. That's what control is. And it's the same for both sides. So we're going to go back and forth. It's pumping. You want to pump tension, and there's always those zero tests in the middle. You'll pump it, burn it, back towards zero, back towards zero. And right now we could do either with 30-minute, either way, because we're at negative 30% tension-ish. We could burn this lower and then we could do either. No big problem there. But we set this up I want you to really understand how this set up. I mean, I did this longer video today because I see that what's going on. And you guys had some questions, and I'm just like, this is a good opportunity. We trapped in bears here, and we trapped in bears here. We did a big old fat drip and rally here, a smaller drip and rally here. This was absolutely completely geared to trap in those bears. We walked through it. I hope you guys were able to take advantage of it. I really do. And now things are just taking off. I don't think this was unprecedented. I think this was very precedented. I think we developed this. Joe saw it coming apparently last week. I saw it coming Monday throughout Monday. I think it started to be clear. Today we're just reaping the benefits of a trend. I really hope you guys were able to take advantage of this. My goal is not to give you trades. My goal is to help you understand the narrative so that you can use whatever your favorite tools are to take trades. I think this is just totally fine. And hopefully, if you've been watching this, you kind of know where I think it's going to go. And I left them on my chart. We want to get this gap here up to the 31.13. If you remember back a while ago, let me just show you this. If you remember this, we had the market come down. The bulls sort of have good opportunity. They screwed up, and then they screwed up, and then the bears came in. And there's this huge gap here. And after we had looked over it, thought about it, I thought the only real place for these bears to stick their stop was up here. Because at the time, that's where I thought made the perfect sense for the bears to stick their stop. So in my opinion, that's where it's headed. And we've been trying to get to this point for a while. We almost got up there. The bears didn't quite get it going. The bulls were able to pick up control, and now I think that's where we're headed. So I'm not the biggest fan of laying out profit targets, but I've been tracking that for a couple days, so I think it's a pretty good expectation that that's where things are headed. Yeah, that's that. I'm not sure there's going to be much else to do today. I think today's just... Oh, well, yeah, there's like a couple minutes left. So my expectation is to see it move up. I want to make this really, really, really clear. Please make money. Please. Your goal is not to capture all the money. It's to become good at figuring out where the money is going to transfer, who, what, where, the structure, why. Make money. Don't make all the money. You need, in my opinion, if I had to lay down and if I were to go talk to my younger self, I would say you need a reliable 10 points on the ES. If you can't capture 10 points, which is $500 per contract, reliable meaning it's more often than not you feel like you figure out what's happening and you can capture 10 points out of it. If you can't do that, you won't be able to grow your trading account, because more often than not, you're going to be losing 5 to 10 points per trade. The ES sort of requires that or more, and especially these days. So you need to be able to guarantee that. With the type of market volatility that we have now due to the micro contracts, you need to be able to pick up 10 to 50 points, just because you're going to be risking 10 to 30 on your trades. I mean, things have just gotten a little bit bigger. I think it's because of the micros, because there's a lot of uncertainty in the world. The point is this: once you figure out the narrative, whether you got in here, you figured it out here, or you saw this come down and you believed me, maybe you got into here, don't catch it all. Catch a good chunk. And here's what I mean by that. Your entry to your profit target is going to have things in the middle. The first section you're going to deal with, the first move, is where that it doesn't really take off. You feel like it's winning because it's +4, but you're not, because at any moment that +4 could turn into -2. Basically, your position is essentially neutral until you get at least 7 or 8 points away. And even then, it's not neutral if it's not making milestones in the narrative. So the first phase is where it's up, but it's not quite there yet. The second phase is where you get those milestones. You're like, oh my gosh, it is. So I would say right about here, we were like, okay, drip and rally, great, drip and rally. And then it broke to a new high. It was like, okay, we're getting milestones. It's doing what we expect. The third section is the last one. It's the exit part. And this one has to do with what you expect. What is this narrative concluding? Where is the tension? What's the cadence feel like? And I think that's pretty good. You see that? We ticked up. I think we liquidated this group, this group, and anyone left over here. There it is. I'm out. I'm flat as can be right now. I want you to know that. So my goal is to look for the milestones, and the exit for me is pretty much always liquidation unless there's some other bigger narrative. And personally, I like to just catch, I like to catch the impulses. I love impulse trading because it tends to be pretty directional. You know where your exit is. So for me, these are the phases. The first phase, it's working, but it hasn't met a milestone. The second phase is in the second phase, you're going to get milestones. And in these, you're going to get counterpoint. And the last phase is when do you exit? Now, I think that these trades, if you exit during the milestone, or even worse, you exit before the milestone, you're doing a bunch of things. One, you're expressing a lack of confidence in yourself. If you got into a position and it was going positive and you exited here, or worse, here, what happens is you just told yourself, I don't believe in you. You're stupid. And it's going to hurt real bad when it takes off without you. It is better, and this is from cold hard experience, to lose money believing yourself than make money betraying yourself. Meaning your analysis says it should go up. Everything that you have on the charts, you put it together, says it should go up, and you short and make money. You have just devastated your psychology. Devastated. Making money, betraying yourself, lying to yourself will destroy future profits. While losing money, trusting yourself, does not affect future profits. You can come back with a clear head, okay? This is really important. I think that you should do what you set out to do. If you got into this market and you decided, well, okay, they liquidated, that's what we always look for. They liquidate, you exit, and you were able to capture maybe this. You set out what you meant to do and you did it, and you will be better tomorrow because you'll say, I am smart enough, I know what I'm doing. Now, overconfidence will creep in. You'll say, I know what I'm doing, and you'll try to be a hero. And heroism is where you have some evidence of success. So you say, I've had some success, and so I'm the hero. And heroism always shows up because you're trying to make this one statement, which is my least favorite statement that sometimes my children say. It drives me nuts. I told you so. Heroism is the way you know you're walking towards overconfidence and about to get hurt. Heroism is where you're attempting to leverage your past to make yourself right. Like somehow you're more right than you were. And heroism will crush you. You'll come in like a hero saying, I will help you. I will help. I will come down to your level to help. You should be blessed that I am telling you my silly little opinions. And the truth is, I know you guys don't care what I think. Nobody cares what I think. I'm nobody. But you will get crushed by heroism. Heroism is where you claim to yourself you have some evidence that you are successful, and you try to leverage that evidence to make yourself more right than you are over other. It's always over other people. You're trying to say, I told you so. Guys, I told you. Didn't I tell you? Didn't I told you so? Didn't I told you tell you? And you're leveraging whatever your past is, trying to like, I don't care if you told me. What are you telling me now? And what you're telling me is you're a douchebag. That's all I hear. I don't hear anything else. You're a jerk. So you have to be careful of heroism. Watch out for it. So if you did well today and you felt like you kept up and you understood, beware of heroism. It seems like a good idea going in. You'll catch yourself because you're somehow condescending. And it's always the same. You're unwilling to let somebody dissent from your opinion. Like they say something, you're like, no, that's not right. And you can fight heroism by allowing other people to share contrary or different opinions. And where the hero runs into problems is that if you say down and I say up, that's okay. Why do you say down? I'll listen. Why do you say up? Now you listen. Okay, let's think, well, maybe we move down and then move up, or maybe it's not going to move down because I have a good reason. We communicate. Then we wait and risk. Because I could be wrong, you could be wrong. What a hero can't do is listen. What a hero can't do is accept risk. Heroes cannot be burdened with risk by opponents. So you might be able to pick up on your heroism that way. When you go, oh my gosh, I can't hear anyone else. I can't listen. I can't be burdened to think that you might be right. You're stepping into hero territory, and heroism is overconfidence, and you'll end up being just blatantly wrong and having some humble. So just as a word of warning, if you did well today and stuff like that, just remember heroism is a thing. You can observe it in yourself by tracking that inability to hear other or contrary opinions and your inability to accept that they could be right in the future. You'll say, no, that's you little rat, you little peasant. You don't know the intelligence of my people. My people are the winner people. And you should be grateful that I stepped down here to the poor peasant people, and I'm sure you have no ears for anyone. Like, I've done it. We've all done it. So, all right, well, I hope this was really useful. I think we got our liquidation right there. If you saw that, that's what I was looking for. It moved up into the area I was wanting. I'm not that big of a fan of holding for multi-impulse moves. I just like to take the money and walk away. There, you can also see we had some bears try to pop in here. We had bears pop in here. The market leaned back, gave us a little sample right into the close, but no volume. So that's where we're at. Bears, for whatever reason, tried to sell here, to sell here, to sell here, and to sell here. They're just adding to a loser. Anyway, that was the trade. I hope this was helpful. Thanks for the questions, the feedback you guys have been posting. I read these things. I think about them. Even if sometimes I'm quiet, honestly, sometimes I just don't care to talk to people. So, really glad to have you guys here. I think this is a really good community. I'm really happy with the people that we found, and we've rounded up. There's some people who have some edge and they're angry. We've seen some nice people, some opinionated people, and I love it. I want it all. Everything we can get. Just make sure that you're trying to post genuine information. If you're an angry person, you genuinely think it's angry, post it. If you're too nice, post it. Just post what's true to you. We can use that. What we can't use is nonsense. If you're just like make things up just to post, I don't want that. I want what you really think. What you really think, because you're as valuable of a trader over time as I am. Some of you may be more valuable. That's what we're looking for. So, all right, I will see you guys tomorrow.